For married taxpayers, the big exam trap is assuming both spouses must own the home to get the $500,000 exclusion. Not true. On a joint return, only one spouse has to meet the ownership test, but both spouses must meet the 2 out of 5 year use test, and neither spouse can have used a Section 121 exclusion in the prior 2 years. If the MFJ requirements aren't all met, don't panic. Often you still get a $250,000 exclusion for the spouse who qualifies. Also remember, unmarried co-owners don't share a single $250,000 cap. Each person applies Section 121 separately on their own return, based on their own ownership and use. On the EA exam, they love that each taxpayer, each limit idea. Divorce creates a special ownership rule. If a home is transferred incident to divorce, it's a Section 1041 tax-free transfer, and the receiving spouse gets carryover basis. For Section 121, the receiving spouse is treated as owning the home during the time the other spouse owned it, but the use test is still personal. The receiving spouse must have lived there 2 years out of 5 to get the full exclusion. After a spouse dies, there's another generous rule. The surviving spouse is treated as owning and using the home for the deceased spouse's periods. That can preserve the full $500,000 exclusion, even if the sale happens within 2 years after death, so long as the survivor hasn't remarried before the sale. Exam tip: look for sold within 2 years of death and not remarried. Military and certain government service can suspend the normal 5-year look-back window. For qualified official extended duty, the 5-year period is suspended up to 10 years for armed forces, foreign service, Peace Corps, and intelligence personnel. That means you can ignore those years away when measuring the 2 years of ownership and use. It's basically a timeout on the clock. Disability has its own relief, focused on the use test. If the taxpayer becomes physically or mentally disabled, they can be treated as living in the home while they're in a licensed care facility, like a nursing home. Key condition: they must have owned and lived in the home for at least 1 year, and they still must meet the 2-year ownership test overall. When the 2-year rules aren't met, you may still get a reduced exclusion. You take the maximum exclusion, 250 topics to $400,000 or $500,000, and multiply by a fraction. The numerator is the shortest of time owned, time used as main home, or time since the last Section 121 exclusion. The denominator is 24 months or 730 days, but you only get this if the sale is due to work, health, or an unforeseen event. 2 more edge rules show up in tricky questions. Land by itself usually doesn't qualify. Selling just the dirt without the home means no Section 121 exclusion, but an adjacent vacant lot can qualify if it was used with the home and sold within 2 years before or after the home sale. The IRS treats them as one transaction. And if only part of a property is your residence, like 1 unit of a duplex, only that portion of gain is excludable. According to the IRS, which factor does not weigh in favor of the IRS approving equitable relief? The choices include abuse by the spouse or former spouse, poor mental or physical health when the return was signed or relief requested, the taxpayer still living with the spouse, or none of the above. Think about which one is actually a negative factor. The correct answer is the taxpayer requesting relief still living with his or her spouse. Living together generally cuts against equitable relief, because it suggests less separation and less hardship or control issues. A tempting wrong choice is poor health, but that one usually helps the taxpayer. It weighs in favor of relief. Darius is an ordained minister and receives different types of income from the church. Which item is subject to self-employment tax? The options include a minister's housing allowance, mileage reimbursements under an accountable plan, group medical insurance benefits, or none of the above. Think about what's excluded from income tax but still hits SE tax. The correct answer is the minister's housing allowance. Ministers often exclude it for income tax, but it's generally included in net earnings from self-employment for SE tax, unless a valid exemption applies. The tempting wrong answer is mileage reimbursements, but under an accountable plan, those aren't taxable and aren't SE income.